Welcome to this explainer. Today, we're decoding a massive financial mystery that's quietly brewing right beneath the surface of the global market. We're talking about a 2.5 trillion with a T dollar tidal wave that almost nobody sees coming. And honestly, the crazy part? The data is sitting right there in front of us, but the silence surrounding it is entirely by design. So let's dive into the numbers together and decode exactly what is happening, step by step.
If you turn on the news right now, everyone's distracted, right? We're all watching stocks go vertical, chasing the latest artificial intelligence hype, but meanwhile, the bond market, which historically is considered the boring, predictable, adult in the room that your grandpa falls asleep watching, is quietly pulling the plug on the party. It is flashing a massive warning signal that we literally haven't seen in nearly 2 decades, and the damage is already starting to surface.
You see, the U.S. 30-year Treasury yield recently spiked over 5%, hitting levels we haven't seen since 2007. Now I know, Treasury yields sound like a topic reserved for finance guys in Patagonia vests drinking $8 iced lattes, but hidden inside that headline number is the actual price of money. It determines the borrowing costs for trillions of dollars of debt across the entire global economy.
And it's not just a U.S. problem, it's a global phenomenon. The UK's 30-year yield climbed to its highest point since 1998. Germany hit levels we haven't seen since 2011. Japan's 30-year is sitting at an all-time high. When 4 of the largest sovereign bond markets in the world start acting with the volatility of Dogecoin, you really have to ask yourself, what is fundamentally cracking in the system?
So, Section 1, Bonds 101 and the underlying mechanics.
To understand the symptoms we're seeing in the headlines, we really need to look at the root cause. In its simplest form, a bond is just an IOU issued by a government or a company. And there's the strict inverse relationship here. If buyers are scrambling to get in, the price gets bid up and the yield falls. But if buyers aren't interested, well, the price drops and the yield absolutely has to go up to attract them. Price down, yield up, it's really that simple.
So why is everyone demanding higher returns right now? Basically, there are 4 main reasons. First, the Federal Reserve hiked baseline interest rates super aggressively. Second, inflation is threatening the long-term value of your money. Third, the U.S. is issuing Costco-sized amounts of new debt, just flooding the supply. And fourth, demand from foreign central banks and institutions is starting to pull back.
Which brings us to Section 2, the floating rate trap.
While those long-term yields grab all the headlines, the real pain is quietly devastating companies on the short end of the yield curve. Let's look at the trap thousands of companies have walked right into. This all comes down to a rate called SOFR, the Secured Overnight Financing Rate. Think of SOFR as the overnight borrowing receipt for the entire U.S. financial system, based on actual trades. Back in early 2022, SOFR was effectively zero, but thanks to the Fed's rate hikes, it rocketed past 5% by mid-2023. And that massive jump completely upended the math for corporate borrowing.
Most of us think about debt as a fixed rate block, right? Like a standard mortgage where you lock in your rate and the payment never changes. But the massive private credit market relies entirely on floating rate debt, meaning they are along for the ride. Their debt is pegged directly to SOFR. So, as SOFR shoots up, the borrower's interest payments aggressively shoot up right along with it.
Let's humanize this a bit with a software company called Pluralsight. In 2021, they got acquired by a private equity firm and loaded up with over $1 billion in floating rate debt at near zero rates. The math worked perfectly back then, but when SOFR spiked past 5%, they were absolutely crushed by the rising interest payments. It got so bad that by August 2024, they were forced to restructure, and private credit lenders took a staggering 85% of the company's equity just to keep it alive.
And that brilliantly illustrates the wider problem. Pluralsight wasn't some unique, isolated incident. They were just one struggling borrower sitting in a massive, highly exposed stack of companies all facing the exact same compounding rate shock. It's like JP Morgan CEO Jamie Dimon famously pointed out about credit cracks. When you see one cockroach, there are probably more.
And the hard data totally backs that up. The Fitch private credit default rate, which tracks over 500 of these middle-market borrowers, just hit a record 6% on its trailing 12-month measure. That is literally the highest rate recorded since the index started. So yeah, the cracks are absolutely showing in the foundation of this exploding asset class.
All right, moving on to Section 3, the sneaky accounting cover-up.
So here's the crucial point. If defaults are hitting record highs in an asset class that grew tenfold since 2007, why aren't we seeing widespread panic? Why is the industry acting like everything's perfectly fine? Well, the answer lies in a highly creative accounting mechanism called a payment-in-kind feature, or PIK. It's basically an arrangement that lets a borrower make their interest payments by simply adding what they owe to their total principal balance, instead of, paying actual cash. This mechanically removes the trigger for a formal default. The loan isn't stamped as bad, it just grows larger.
Just follow this sequence of events, because the cover-up here is wild. First, the borrower can't make their cash payment. Second, that interest gets slapped onto the principal balance. Third, the private credit fund reports that unpaid, rolled-over interest is actual income on their books. And fourth, because a lot of these funds operate as business development companies, they are legally required to distribute 90% of their taxable income to investors using actual cash, meaning they're paying out real cash dividends based on money they never actually collected.
And this accounting trick is spreading incredibly fast. PIK features are now sitting in 11 to 12% of all private credit loans. That represents a massive 72% jump just since the end of 2021. And a huge portion of these were added way after the loans were originated, likely because the borrowers started choking on those soaring SOFR rates. What I found absolutely crazy is the reality of this phantom income. Across public business development companies, roughly 8% of their reported income is just unpaid cash. For some public funds, like FSKR, it's over 14.5%. And here's the kicker. Out of 11 defaults Fitch recorded in a recent single month, over 60% involved adding these PIK features just to mask the underlying financial bleeding. It's happening right under the market's nose.
To make matters worse, because these private credit loans happen in the dark without public trading prices, they are valued using what's called Level 3 accounting. This is the most illiquid, subjective category in financial reporting. It relies entirely on the fund's own internal models instead of active market data. Yet even with that lack of transparency, research shows over 10% of private credit loans have already been internally marked down by at least 50 cents on the dollar.
Which leads us to Section 4, the final reckoning, the maturity wall. This brings us to the ultimate consequence of letting distressed borrowers roll their unpaid interest into ever-growing loan balances. Eventually, the bill comes due. We are staring down a massive maturity wall of $85 billion in business development company loans, coming aggressively due between 2026 and 2029. That means all of this debt, much of it from the near-zero rate era, compounding ever since, is going to have to be refinanced at today's punishingly high rates.
Look, you can hide a loss on a spreadsheet. You can roll unpaid interest into a bigger principal balance. And you can temporarily slap a performing loan label on a distressed borrower just to keep everyone calm. But bad math doesn't simply disappear. The math is still the math.
As this $2.5 trillion tidal wave silently crests over the entire financial system, it leaves us with one pretty provocative thought to walk away with. When this massive wall of debt inevitably rolls over in the coming years, and these companies are forced to face reality, will the math finally catch up? Thanks for joining me on this explainer. Keep your eyes on the data, and I'll see you next time.